Good afternoon, everybody. Yeah, welcome to this session about startup financials. So today we'll be talking about money. And I think basically the way we should frame the discussion here is that traditionally, if you think about this kind of Friedmanian doctrine, the function of an organized of a company is to make money, basically to turn into profit for the owners. And that's a kind of very old-fashioned, very worn-down definition for entrepreneurship. And obviously, what we're doing here, focusing on SDGs, focusing on sustainability, trying to do something that actually matters for people, that provides some real value for people. So we often get focused on something else than turning into profit. Another reason why this traditional doctrine is not amazing for us is that we're not talking about building a factory and optimizing the kind of the inputs and outputs in the factory to turn in as much overhead of profit as possible, but we're talking about startups where often things like scalability and growth are actually more important than profitability. And if you think about many startup success stories like Twitter or Facebook or in Finland Volt, often these companies operate at the pretty hefty negative profit margin, really turning in a lot of ginormous losses. And then many traditional economists have been wondering about what is all this fuss about startups going on, that why would anybody put millions in a company, invest millions in a company that's turning in tens of millions of losses annually. But the thing is that actually when you're running a startup, you want to get very fast to a point where your entire business will be massive. And in getting there, you can easily run a business that's not profitable insofar as you're funded properly. But then once you get there, at some point, ideally, you should, try to establish a more traditional line of business. So there are two reasons why, really being mindful about, these questions is important. And I would venture to say that neither one is the traditional, how can you get rich fast sort of question. But rather in a kind of a present day, especially sustainability driven startup, the two focal points you should be primarily mindful about are impact and growth. But often when people spend a lot of time thinking about the impact and growth, and especially when they spend a lot of time thinking about being an ethical entrepreneur, doing the right thing, you might get sidetracked from the fact that you are still running an enterprise. You're still running a company, which is you're running a business, and the fuel for a business is money. So if you don't really kind of dive deep into this, I would venture to say semi-boring nuts and bolts about how you manage your cash flows and how you work with your accountant and stuff like that. You're risking a great deal that even if your impact profile would be amazing and your growth opportunities and your scalability potential would be off the charts, if for example, if your cash flow management skills aren't amazing, that's gonna probably bite you in the back sooner or later. So what we're gonna do today, so first of all, we'll go through some of the types of income that are available for a startup. So a startup isn't a typical, as you've probably already learned, it's not a typical type of organization. But actually, especially in the early stage, when you probably don't turn in much of revenue, there's a bunch of other ways you can keep your company afloat. Then we'll talk about cash flow, budgeting, profit and losses, and building a financial model. And I would venture to say that out of these three themes, the first one is by far the most important. So basically, how you manage your cash flow. There's even a saying in the startup ecosystem, cash is king. So basically, no matter what, your P&L might look super ugly, but if you have enough cash in the bank, you're still in the game, and you can still take a lot of shots into building something that will eventually also then be reflected in your profit and loss analysis as something beautiful at the end of the day. Then we'll be talking a little bit about the investment documents, mostly about the cap table, which is like one of the most important documents you need to be able to manage and procure for potential investors, especially once you start doing more of the like formal, like alphabetical rounds. Like the structure of the cap table really, like, it matters a lot. And another thing about cap table is that it's also, or the capitalization table, so it also, like, is an important way of, like, demonstrating to your employees that, like, that you really, like, appreciate their work, and you really have them, like, fully in the game by awarding them options that you then mark down as part of the capitalization in the company. And we'll have a short break in, so the lecture part is going to be like 45 minutes or so, and then we'll have a short break. And after that, before the break, I'll give you some instructions. So Heidi will distribute these templates to you guys, and then we can actually start working on the kind of budgeting, cash flow projections and cap table for your own team's startup. So that's roughly the kind of, like, lay of the land for today. And like I said, I mean, I've never personally been, like, very driven by money. I really sort of, like, subscribe to this, like, Richard Bransonian, like, he has this saying that, have fun, do good, and the money will follow. And I think that up to a point that does that is accurate. But having said that, I mean, if you're like totally not like unfocused on how your, like, sort of financials work in your company, is probably not going to be worth much. And ultimately, I think, like, learning about this stuff at this point really makes a ton of sense, because, like, that way you can eliminate also, like, making stupid mistakes or making a fool of yourself when you're, for example, talking with investors. And I have some personal experience about that. So, like, be forewarned, don't do the same stupid mistakes I made. But one of them was that, like, back in the days, I was doing fundraising for one of my companies, one of the first, like, larger rounds that I closed at, like, about 650K, and then expanded to about 3 million ultimately. And then, so I was doing some of the first investor calls of that round with this British, very respected VC. And then, like, halfway through the call, I was sitting in this, like, Sokos 10th floor restaurant in the 10th floor of the Sokos next to the railway station in the center of Helsinki, and having this Skype call with this amazing lady. And then she goes like, "Oh, so what does your cap table look like?" And I'm like, "Well, it looks like," and then I'm rushing to Google, going like, what on earth is a cap table? Going to Wikipedia and hedging and buying time, and going, "Well, the cap table, it's like, it's a very nice, it looks," and trying to read that Wikipedia page at the same time, and going like, so a cap table is like, the reflection of the ownership and investment in your company, and it's basically usually just a very simple spreadsheet. And then ultimately, like, I sort of kind of like winged it and managed to figure out what she was asking me. And then I went like, yeah, we're sort of like, equal share founders in the company. And the problem was that actually out of the 4 founders in this company, 2 of them were actually like, early stage investors and not operatively involved. And that was the first sort of like, so I mean, you can probably like guess what happened, like, with the round with this investor. No, they didn't invest in the company. But what I learned was that actually, like, having a situation where you have 2 operative co-founders, me and Lauri Konttori, owning 50% of the company before a single formal investor comes on board is actually a very bad situation to be in. But luckily enough, at that point we hadn't actually incorporated the company, so we were kind of like, really early on already like approaching the investors, and we were able to remedy that, and we were able to redesign the cap table so that me and Lauri owned most of the company, and then Peter and Niklas, who were the investors, like, came in with a smaller share. So, in the end, it all worked out quite nicely, but I would rather, you guys don't have to go to the situation where an investor asks you about this, at the end of the day, pretty like, nuts and bolts or bread and butter stuff. And then you have to rush to Wikipedia and hope that you'll be able to learn what we'll be talking about in the next 45 minutes, in the next 45 seconds during a Skype call. So that's just kind of like, to give some idea about where I'm coming from also in terms of these topics. So yeah, let's go to the kind of like, the first part. So I mean, obviously, like, the kind of the long and the short of like, what your financials consist of are the input and output streams of money in your company. So some stuff comes in, something goes into your bank account, and then a bunch of stuff goes out of your bank account. And obviously, the kind of like, the kind of like the short version of today's lecture is like, try to put more in than you're taking out, right? So that's kind of like, the like obvious kind of conclusion about this. But obviously, like, I mean, that's a kind of a luxury that most startups don't have. So often, like, what you do is that first of all, you try to create as conservative a cost structure as possible, and then find the type of funding that would enable you to run that operation as long as possible. So basically, we got a couple of terms. I'm not sure if you've talked about this before in the class, but one of the kind of like key terms in startup lingo is this idea of a runway. So in a sense, you can think about the startup as an airplane that's like, rushing down the runway, like, hoping to take off. And the business is sort of like, I mean, if you've structured your business properly, it's like, you guys know the Wright brothers who designed the first operational airplane. So they tried different kinds of forms of wings. And like, once you get your wings properly shaped up, then, your airplane may take off. Often, like, I mean, like 9 times out of 10, roughly speaking, like, the planes don't take off, they crash into the end of the runway. They run out of cash, and they're not operational anymore, and they shut down. So obviously we don't want to go there. So what you need to do is, like, first of all, try to, like, squeeze in as conservative a cost structure as possible. A couple of great examples how to do that is, like, for example, like, when Amazon was starting, Jeff Bezos started this like hyper frugal spending culture in the company. And this is often like, if you take a look at the ecosystem, this doesn't like, usually take place, especially when like, people who haven't been used to managing like millions of euros all of a sudden are managing a bank account with like several millions of euros. It becomes a little bit overwhelming, and people start like sort of like getting lost in all that money. So in a sense, like, there's also a situation like, that the most dangerous situation for startup is running out of money. The second most dangerous situation is getting too much of it. So that's also like, that in addition to being frugal about your cost structure, you'd want to be like, sort of sensible about how much money you bring in, for a bunch of reasons. One of them is like, simply that most of us haven't been brought up with the capability of managing millions of euros like off the bat. So like, it'll take some time getting used to that, and it's better to ramp up to those sums. And then the second thing is like, that if you have too much resources, the temptations to start diversifying your operations to be able to match those resources becomes larger, and that means that you'll start doing stuff that's not actually like totally focused. So in that sense, taking a page from like Jeff Bezos' playbook makes sense, and like try to be with all of your expenses, all of your salaries, all of your spending, all of your travel. Try to be as frugal as possible, but like not not more than that. Obviously, like you don't want to save yourself to death. And what Bezos, for example, did, like instead of buying tables for the early Amazon offices, they went to these like these like sales and bought old doors and then hammered those to like to table, like wooden table legs, and they used those as tables in the office. And I think like I'm not sure about this. I mean, this was an old like Amazon like history that I read a couple of years ago, but I have the sort of like feeling that they might actually be still using those types of table, even though they're turning in a ginormous profit these days. So so I mean, you want to be frugal about your spending, but then the other thing is like that ultimately like the equation that matters is like how much revenue you generate, so how much money your customer gives you, which is like directly proportional to your value proposition, so how much value you generate for the customer. But and then like how big your expenses are, and if your revenue is over your expenses, you're turning in a profit, like basic sort of business 101. But because in early stages, like I mean, obviously, like and you should always from the get-go, and this is what I tell all startups that I'm mentoring or helping, is that you should try to get the revenue as soon as possible, because in the ecosystem there's so much of this thinking. And if you read the startup news. There's so much of these, startup XYZ just raised $1 million, like startup Z raised $50 million. And then we think that, so they're really successful because they've been able to get like $50 million of capital on their bank account. And yeah, I mean, obviously, it is a type of success, but there are so many of these stories where people have had a very compelling, very trendy proposition for investors, and they have been able to create a kind of competitive atmosphere. So they've been able to raise a ton of cash, and eventually they haven't been actually able to build something that would have an actual value proposition that the customer would pay for, and therefore generate revenue for the company. So that's why, even before you talk to even the early stage of investors, look at your product, look at your value proposition, try to think about, is there some way you could actually find a paying customer right now, and not at the end of your the projection, the hockey stick projection in your deck that says the 12 months after the first investment will be turning in some revenue. So revenue is always the ideal and the best type of income you can have for your company, because that's actually money you are making. The other types of money that you can put in your company, I mean, and you probably need some of this anyway to get your startup off the ground. So they come with various types of strings attached. So I've actually listed now the types of income here in order of preference. And actually, if you think about it, often startups operate exactly in the reverse. So once you've got great pitch deck and somebody came to you in Slush telling that you guys are onto something, and then you're spending 6 months just chasing investors when you could have actually spent that 6 months creating the value prop for your customer and generating revenue. And so there are two problems with that. So first of all, investment money never comes for free. So it's actually the most expensive money you can raise for your company. It actually, if you're successful, it costs you way more than any of the other types of forms of income that you can actually put into your bank account. And then the second is that almost every time, unless you're in a hyper strong place to raise money, an investment is a kind of a golden handcuff situation. So you're going to have to give a lot of decision-making power in the company to investors. And in some worst-case scenarios, there are even horror stories where investors have just basically taken over a company and kicked the founders out. And that typically doesn't happen because that would really give the investors a really bad name. But it's there are stories like that even taking place. Often, I mean, if an investor, obviously, if somebody invests in your company, they do want to work with you. They want you to be successful. Investors actually, and this is one of the points I already mentioned about cap tables. Investors want you to be the most successful person financially if your company gets all the way to an exit. So an exit, I don't know if you've talked about this in the class before, but an exit means a situation where you're actually able to convert your ownership in the company into cash. That usually happens if your company is sold to another company, or if it's put IPO'd into the stock market, given an initial public offering where your company shares are being offered to the general public for purchase. And in those situations, usually these are actually the first times that a startup founder actually starts to see any of the kind of payoff for that work. So often you're going to have to work at a low salary, you're going to have to work long hours, and you might or might not get paid off in the end. But that's the sort of the fiscal reward at the end of a successful startup journey, is that you'll eventually end up getting a ton of cash. And unless you have totally nutty investors on board in your company, you will have the most of that cash compared to, for example, the investors and other stakeholders, because it's basically they kind of received you in the investment ecosystem that if the founders don't, at least in the early stage funding rounds, retain more than 50% of the company, their motivation drops so much that the likelihood of the startup being successful diminishes. And this is why you'll want to be very mindful about how you structure your cap table, and especially when you're bringing in investors. A huge red flag is if an investment collection of investors who would want to fund your company are demanding more than 20% total shares in your company. If somebody's asking for more than that, they probably don't really know what they're doing. So like, just keep that in mind. So the types of income that you can have in a startup. So you can, obviously revenue is the best type of income you can have. Grants, like, especially in Finland, like now, like for example, in Lightneer, our American investors were constantly dumbfounded and perplexed about like, us having such a government-funded entity as Business Finland, that you can actually get millions of money from the government entity that's non-dilutive. So that means that like, Business Finland has instruments ranging from like the tempo funding, which is like about 50K, all the way to like several millions of euros, which are structured usually as grants and loans. And that means that they don't dilute the ownership in your company. So like, if you're not able to generate, once again, like, if you have the slightest chance of generating even a small amount of revenue off the gate, go for it. Then if you don't have revenue, you're going to need to, scramble for income somewhere else. So the grants are the next best step, like, to go for. And the grants are like, there's also like, in addition to Business Finland, there's like ELY-keskus, there's all kinds of foundations, all kinds of like, parties that you can at least get like small, like 10, 20K grants from. And the beauty of this type of money is that like, once you get it, it usually doesn't really like, tie you down in any way. And especially if you make an exit, you don't need to pay that back. So it's kind of like, that because the other types of money you do need to pay back in various forms and with various forms of interest, but with grants that's not the case. But then this is kind of like something that that often like entrepreneurs don't really like take to heart. So the next best type of funding for a company is actually a loan. Whether it's a bank loan, whether it's like, a loan from Business Finland, from Finvera, from like some of these like startup supporting parties, like, it doesn't really matter. Obviously you can get better terms and like, lower interest from these parties, but still like, the reason why loan money is actually like a good instrument, given a couple of caveats which are actually super important, so please pay attention. So is that yes, loan money costs you money, and that money is the, the compound interest that you're going to have to pay based on that capital. So like, if you take a 10K loan and it has, a 2% interest, then annually you'll have to like, pay 200 euros to retain that capital. And like, if you don't pay the interest out, that gets compounded with the capital. So next year, the capital you're paying interest on is going to be higher, and so on and so forth. So you'll accrue, an amount of like additional debt as you've taken a loan. But like, having said that, probably like, unless you're taking like a enormous amount of capital with like, like some crazy like 27% interest rate or something like that, the compound rate is not going to be anywhere in the ballpark of what investment money costs you. So in that sense, like, if you're in a position to actually like, raise loan money for your startup, you should really consider doing that. But now the important, like, please keep this caveat in mind. Usually when you go for a loan, unless it's one of these like, startup loans, especially if you go for a bank loan, the bank almost always demands some type of collateral for that loan. And this is where many entrepreneurs like really like stumble, because if you have a company, if it's a limited liability company, the whole idea of this type of entity is to give you a better chance of of managing risk. And that means that if you have loans folded in your company and you run the company like according to the legal statutes, you take care of your accounting, take care of all of that stuff, and you fail miserably, you can shut down the company. You get, you get bankrupt with the company, but the loans don't really break your back. They don't break your personal economy. But that's not the case if you actually put in personal collateral. So there are cases where startup entrepreneurs have put their houses as collateral for like huge loans, at least on a, like on a personal level, like taking like 500,000 of loan and putting down their entire like like everything they own as collateral, and then the company has failed, and all of a sudden you are personally actually like responsible for that money. So when you're negotiating for a loan, the type of collateral is like super important to be mindful about. And you have to basically think about that whatever you put down as collateral for a startup is something that you need to be prepared to lose from the get-go. So it's kind of like, that you should basically never do. I mean, even if usually banks don't really allow this for early stage companies, but even if they did, you should never do a personal, like, kind of like, I don't know what's in English, like henkilötakaus, like, personal collateral commitment. So basically saying that if your company fails, you'll personally take care of the debt, and that's not a fun place to be if if you're a normal human being and you have all of a sudden like 500,000 or 200K of debt with no collateral on your back. But then like the kind of like the beauty of loans is that especially once you're a little further ahead, the cost of the loan in the long haul is not going to be huge. So if you manage the downside, if you manage the risk by using the kind of like finding the type of collateral that makes sense and that you're prepared to lose, and then if you actually end up in the upside scenario, then you don't actually like lose a ton of money because you've been going after the more expensive funding instruments. Just a second, let me see if there's some chat messages. I'll open the chat in. Yeah. Okay. So yeah, but then finally we come to like what is still the kind of like probably the most topical and sort of like sexiest like startup income form, which is investment. And investment means that somebody puts down money for your company. Somebody believes in you, but their motive is not like in the case of grants, their motive is not to support your idea, like no strings attached. Their motive is not like as in the case of loan, to generate that like just a kind of a mechanical interest on the capital that they give to your disposal. Their motive is actually to help you grow like enormously with respect to the investment that you are being given. And that means that basically, so when you're raising investment, especially if you're raising investment from professional investors like seed investors, even angels, and especially once you're going to like like VCs, like doing like seed rounds and series alphabetical rounds, series A, B, and C, and so forth. What you need to keep in mind is that the moment that you sign the paper for the investment, the clock goes on, and the investor will expect you to return roughly 10%, roughly 10 times of the gross amount of the investment in the next 5 years. So that means that if in 2 years you haven't shown traction and shown that you can actually get to that goal, the investors will probably start shuffling their feet. And if they've gotten enough like decision-making rights in your company, they may even resort to some drastic measures to make sure that they have the best possible bet of getting those returns. And the rationale behind this is that obviously, like so many startups fail, so like not all of the startups are going to return 10 times as much. But the thinking is that like if you spread your investments wide enough, and 2 or 3 of the businesses in your portfolio go to that 10x or 20x returns, then your entire fund is actually going to be profitable. And that's why they expect every single one of their bets to be like managed in the sense that they would return that much in the next 5 years. So that's just something to keep in mind, that like the sort of like tempo and the way of working in your company will change on the very day when you sign those papers, even though you might not realize it at that point, and you might not feel it at that point. So that's one thing to take into consideration when raising investor money. The second thing is that, like I already mentioned, investors usually want to have a kind of preferred type of shares. So especially if you don't get to the optimal type of exit scenario. So if you have to sell the company at somewhat lower amount of money than you'd originally projected, it might even end up so that the investors turn in a profit and you get nothing. So that's a very typical situation. It's very hard situation to negotiate yourself out of, because basically the investors will want to do everything they can to protect their downside. But then the third thing is that when you are in a situation where you actually do make a good exit, like that the sale price of your company or the IPO meets or exceeds the expectations. Now what happens is that usually you will have something in the ballpark of like 20 to 40. I mean, if you've managed your cap table well, you'll have something in the ballpark of 20 to 40% of investors in your company. And that means that if you think about the gross costs of the actual funding in your company, So if you sell your company for, let's say, 100 million, and you have investors, owning 40% of your company, that means the investors will rake in 40 million euros altogether. Now, if you have raised that money, let's say that you've actually originally raised, just doing really dummy math here, so you've raised 4 million euros with the expectation that that will rise to the value of 40 in 5 years. Now in 5 years you got to that situation where you can sell your company. So you've actually paid 36 million euros for those 4 million that you brought in the first place. And if you'd actually taken, even at the very, at an insane interest rate, you'd taken the 4 million as a loan, and having it raise compound interest through 5 years, it would be nowhere in the ballpark of 36 million euros. So that's obvious, it's a kind of a happy problem, because I mean, if they make 40 million, you'll make 60 million, and honestly, if you make 60 million or 90 million, it's not such a big difference at that point, at least unless you were a billionaire when you started. So in that sense, you have to be also mindful about what all of these forms of investment mean. But it's also something, and I actually learned this very late on in my startup endeavors, that that investment money is de facto the most expensive money you can bring into your company if your company is successful. Investment money, I mean, it does have some upsides to it, obviously. First of all, you should always try to get smart money in your company. So there are some really amazing investors, like in Lightneer, for example. I got to work with some of the most phenomenal US Silicon Valley investors there are, and that was really just as a kind of a didactic experience. It was just amazing to learn from those people and spend time with them. And some of my investors were in I think in Snapchat and Facebook and stuff like that, so they were really savvy about how that landscape works. So you'll want to bring in smart money, but then also the kind of the good thing about the investment money is that the money is actually given to your company in exchange for that ownership in your company. So if everything goes belly up, you don't really owe anybody anything. Now, once again, in a sense, I mean, with bank loans, it doesn't quite work that way. But if you haven't put down personal collateral for the bank loan and your company goes belly up, then basically the loans just get written off, and whatever there's in the balance sheet of your company gets distributed to your creditors. So in that sense, balancing how much you're working with loans and investment is a kind of a delicate act. And then ultimately, there's also the question that if you have a great pitch, you may be able to get even hundreds of thousands of or even millions of euros if you're amazing at pitching very early on in your company. But you'll never be able to pitch to to a bank loan officer, because no matter how great your pitch deck and how great your value prop looks like on paper, they're going to want to see that collateral anyway. So that's kind of the kind of long and the short of the types of income you can generate in your company. And once again, the key takeaway here is that no matter which of these types of income you put in your company, they have to somehow be able to cover your expenses through a reasonable enough amount of time, so that you have a fighting chance of actually getting your business off the ground and generating enough revenue to be able to manage your expenses. You can game this a little, if your revenues are constantly below your expenses, if you have a steady growth rate, you'll probably be able to bring in a lot of external funding. Then you have to be especially mindful about things that I said about balancing these different instruments. But ultimately, at some point, you would ideally want to get to the point where your revenue actually exceeds your expenses on a steady state basis, and that's usually when you'll start to prepare your company for next. So there are a couple of questions here. How do you view refinancing risk of loans? By Juuso Mikael Hyppä. Could you put some color into that question? I'm not sure if I understand it properly.
So basically, I was thinking that if you take loans and they probably have some kind of expiration date, you probably have to pay them back at some point. So how do you view the risk that at the time of expiration, you're not in the best place to get new funding?
Yeah, I mean that's definitely huge liability in your company. And I think Business Finland loans, for example, they usually have kind of a period of 2 to 3 years when you don't have like, when it's just like, gathering compound interest. But after roughly 3 years, you're going to have to start paying back the loan. But let's face it, like, if in 3 years you haven't been able to generate like enough revenue to take care of like, an early stage startup loan, then probably your company has bigger problems than the loan to begin with. And I think like, I can't really give you a kind of a like, a rule book for this. It really depends on a case by case situation. But like, I mean, the ways you can, try to work with this is like, I mean, if you're in a tough spot, the type of collateral that you're going to need for any future financing in terms of loans is going to be much tighter and like, much more like demanding, and like, investors might still be interested in coming on board and like, backing your company. But obviously if you're just like leaking money and you're not generating revenue and nobody believes in the chance of generating revenue, that's probably not going to be a good position to be in. So I can't really give you a kind of a general rule of how to manage that. But usually, like, especially with the startup loan instruments, you do have a grace period of like 2 to 3 to 4 years. And in these cases, like, for example, with Business Finland, in my understanding is it's often like, if you still do have a realistic position of making your startup a success in that situation, you'll probably have the possibility of negotiating like an extension for this grace period or doing something similar to that. So that's kind of that. Then another question is, what happens when startups don't deliver to investors? What kind of measures do they take to not take huge losses? So there's I don't really have now the bandwidth to go into the intricacies of the term sheet, which is basically like, and the shareholder agreement, which are the two most important documents when you're negotiating with investors. But basically, investors usually try to negotiate terms where, like, especially in the situation where you have to raise funding with a lower valuation than what they actually evaluated the company to be when they invested, so that they're actually like, their risks are covered, and there are like, different kinds of like non-dilution clauses and stuff like that sort of like, prevent the investors from losing like the gross amount of investment in terms of euros in the company. So that means that if the new round is at a lower valuation, the amount of shares of the investor in the company becomes larger. And often in these cases, like, these are the types of kind of like live or die situations where, the investors may end up actually owning a majority in the company, which means that they're not really financeable from that point on, and then they really need to either like, make it or break it. Then the other thing is like, often investors do have decision-making rights, so they may like, do big changes in the management of the company. They may like, I mean, in some cases, investors even themselves become the CEOs of companies in trouble and so on and so forth. So depending a lot on like what kind of terms you've negotiated, it depends a lot on like, what they can do in a tough spot. And to sort of to inoculate yourself against nasty situation, I would really recommend that before you sign anything by a VC or even an angel investor, I would really recommend you read this book called Venture Deals, which basically goes through all of these intricacies of like, fundraising and what you should look for and what you should be like, sort of wary about when talking to investors about money. Cool. So moving forward, this is a kind of type of cash flow budget. So this is actually like a template that I've been using for 20 some years. So I've started 4 companies, and I think the first version I did this cash flow budget was like in 1997 or thereabouts. And so basically, and it's served me pretty well. So I figured like, what the hell, I'll share it with you guys. So I mean, basically, like, they're kind of like the long and the short of it is like, that at the bottom row of this image, you can see the projected cash in hand of your company at any given month. And so what really matters here is, first of all, obviously, like, that you're able to like, generate some form of income, because obviously, like, at the very point where that number is negative, that means that you're done for. Now you can combat the negative figures in two ways. So one, the ideal way is to generate enough income to be able to meet your expenses. The other way is obviously to cut expenses. And that's why, especially early on, you'll want to be as frugal as possible about your expenses. So try to think about what is the absolute minimum, salary you need to pay yourself. When you're starting your company, what is the absolute minimum salary you need to pay, to attract talent in your company? Especially like in this present day situation, like, do you really need an office or not? I mean, there's still office space in here, but I mean, right now, like, if you're starting a startup, you won't need even an office, so they'll save you like, some thousands of euros every year. Then, like, I mean, are you going to put down like Facebook ads, or can you do some like zero cost guerrilla marketing? Are you doing hardware that needs manufacturing costs? Well, obviously, like, also travel costs won't be an issue right now in the time of Corona, but like, back in the day, like, many startups accrued, like, I would usually run, even some like, even relatively early on, like, some like 10K a month on travel, just because, like, for example, in Lightneer, I spent 2 or 3 weeks every month traveling, like, either in the US or Asia. So that's kind of like, also like, often a kind of like expense that becomes bloated up. And then there's like, all kinds of like, office supplies and stuff like that also accrues some costs. So basically, you'll want to just like, monitor your cost types. And then the most important thing here is that you'll want to split your cost types into fixed and liquid ones. So fixed costs are something that that are really hard to get rid of. And whenever you inflate your fixed costs, you should have an idea of the income sources that like at least cover those for at least like ideally 12 months or more. But then liquid costs are something that you can even like overnight eliminate from your budget. So that will give you a little bit of dynamics and a little bit of like, also capability of taking risks in the situations where like, push comes to a shove. And so basically, like, you'll want to, well, I mean, make sure that you have visibility of what are the types of costs that you can actually very quickly eliminate from your budget, if situation becomes really like demanding. And this is also useful, like, that if you're thinking about making some larger investment, let's say that you have an amazing marketing opportunity that you can like, put your product on a new Netflix series or something like that, like some crazy good opportunity, but it's going to cost you like, like 1 or 2 months, like, entire like, expenses in your budget. So it's going to kill 2 months of your runway. So then you'll want to go to your liquid expenses and see if there's something else that you can eliminate, if you can, stop traveling for 3 months or whatever. And that's like, the easiest way to manage that stuff. Then for like, the income sources, like, once again, like, getting to revenue as soon as possible is like ideal. Using grants as a kind of a crutch or scaffolding is like, if it's possible for you, go for it. Then loans and investment, you'll want to have the kind of like delicate balance between the two of them. But ultimately, like, I mean, like, the two other types of financial projections that you can make in a company are like the more traditional ones of profit and loss profit projections. So, for example, in the next accounting period, like, what does your revenue look like? What do your expenses look like? Are you turning in a profit or a loss? Now, if you're running a startup, you're probably anyway turning a loss. And ultimately, that's really not such an important figure for you in the beginning if your cash flow is sorted out. So in that sense, like, even if you're like, I mean, because basically, if you're taking in especially loans and even generating like, some revenue, but if you're like running many of your expenses through that loan money, that's really going to make your losses like, sort of like big in the company. And that means that basically, like, it's going to look relatively ugly. And that's why I don't think like, P&L really is an instrument that like makes a lot of sense in the early stages of a startup. Now, having said that, the Finnish law requires for you guys to turn in basic accounting documents on a monthly and annual basis. And to this end, I usually recommend to people like, that unless you're really a kind of a accounting savant, you shouldn't even like, look into this yourself, but you should just find a great subcontractor who's taking care of this. So I mean, like, usually when I'm giving more lectures in startup experience, so one of the key takeaways from my experience is that you should always avoid subcontractors as much as you can, especially technical subcontractors, because a startup needs to get stuff done fast, and a subcontractor will, want to get stuff done so that they can clock in as many hours as possible. So there's a kind of a direct opposition of incentives in them. And I'm mentoring like a ton of startups in Finland, and often they come to me like, hey, we have this great idea. We were thinking about outsourcing our technology to this company in like, I don't know, Turku or Latvia or whatever. And then I'm like, it's probably not going to work. And the first thing you need to have in your company is to get a technical co-founder. But like for this kind of like so in general, as a general rule, you should always avoid subcontractors as much as you can, and try to bring the talent in your company, because if you bring them in your company, you award them some options, you really like run a great culture in your company, and those people will be hyper committed to get an awesome amount of stuff done in the hours that they work, whereas the subcontractor will want to do as little as possible in the hours, because every hour they get to bill you. But there are two exceptions to this. One is accounting, the other one is legal. So these are the two functions where simply like, having a payroll accountant or a payroll lawyer is going to be so enormously expensive in the early stages of your company. And there are actually like, so many great companies out there who are really startup savvy that you should actually look to outsource these. And then the final, and this one just concerns like, the P&L. So instead of like worrying about it yourself, if you have a solid cash flow projection, you understand how cash comes into your company, goes out, and then you find a great accountant who makes sure that your accounts are in order and everything works, like all the taxes and everything works as it's supposed to, then like, you're good to go. And the final instrument that you or the kind of like, tool that you can have to protect your finances is the the financial model, which is an even more intricate tool that projects like various kinds of accounting issues about your company. And it's usually something like, and I've actually like typically had to even like create a financial model in my own companies at the point when you're actually starting to raise like, like 7 figures of funding. So that's when the investors will want to see all of these intricacies, all of these various like facets of how your like finances actually work, but you shouldn't really worry about that from the get-go, in my opinion. Of course, your minds may vary, and if you ask an accounting professor, they may have a different opinion. So then, one last thing before we wrap up for the break. So basically, like I mentioned, like in the beginning, the cap table is actually one of the most important documents in your company, and it looks like it looks quite unassuming and simple, but at the end of the day, cap table is the way you communicate to the investor who owns what in your company, what are especially like the gross ownership share of the founders, what types of shares do you have, and do you have some way to like to get your employees to commit to the company, aka an options plan. And typically when you start a company, you issue, a set amount of common shares. The good sort of ruling is that like, the common shares should be like, splittable between the founders, or if you don't know how many founders there are going to be, you would want to have it, I think it was divisible by 6, because then it, allows for 1, 2, 3, 4, 5, 6, 8, I think 9 and 12 or something like that. But like, a huge amount of variations for founders without ending up with like orphan shares. And a cap table is simply like, listing up like what everybody owns in the company. I think a good starting point is that, that all the operative founders, so the people who work full-time in the company, own the same amount. So it's an equal share situation. However, like, if there's a situation that somebody works part-time, the founding shares might need to reflect that. If there's a situation that somebody actually, like, for example, when Supercell was started, a bunch of those, the founders actually put their own money, quite a big bunch of their own money into the company. And that was also, like, in my understanding, reflected in their early stage cap table, which then, like, when they made it big, was also reflected in their like, outcomes in that situation. And then, like, like in the case of Lightneer, like, if you have both operative and non-operative co-founders, ideally, you would want to keep the non-operative co-founder somewhere in the ballpark of 10% or less of the entire pool of shares in the company. And then, but then, it may vary. Like, you may have non-operative investors who say that they want to have 20%. If somebody wants to have more than 20%, then they're probably not going to be, they're, once again, like, you should have your warning lights going off and tell them, like, that generally, like, you'll want to have only like 20% of dilution per round of fundraising. And then the one final component in the cap table is the employee stockholder employee stock option plan. So basically, this is a kind of like a bunch of shares that have been dedicated to be distributed out as stock options to employees. And that means that, like, because especially, like, if you've closed around, let's say that you have a company with 100,000 shares, and you've closed around that's like put the valuation of your company at 1 million. So the tax authorities will at this point will consider that each of your shares will be worth 10 euros. And now if you want to give like 1% of the company, or like 1,000 shares to one of the, like your most important employees, that means that the tax authority will treat that as a gift of 10,000 euros, and the person will have to pay taxes in the ballpark of 3 to 4,000. I'm winging the figures. I don't really remember the exact like taxation like amounts, but it's somewhere in that ballpark anyway. And now, like, it still like sounds feasible if you think about, like, a situation where you might have your company valued at 10 million euros. Then all of a sudden, like, you have somebody who probably doesn't have tens of thousands of disposable cash at hand, and you'll have a tax bill of like 50,000 euros all of a sudden, like, and this has actually happened, like, in the startup ecosystem. So that's why you don't want to award actual shares, but you'll have to create you'll want to create a stock option pool, which is basically the option to purchase shares at the valuation that it is currently. So now, if your company is valued right now at, let's say, 1 million, so you can make a sort of like documentation. This is where you need a lawyer usually, where basically let's say 10% of your all of the shares in the company are reserved for these options. Then you'll reflect this reserve with this line of ESOP, and eventually when you start awarding these options to employees, like with individual lines for the employees. And as you can see in this template here, like, then they'll get a set number of options. So basically, now once you kind of like, what happens is, like, once you award an option, the other person actually doesn't get the share. So they don't get voting rights. They don't, if you were actually to pay dividends, which startups almost never do, but if you were to pay dividends, they wouldn't get any, because they don't actually own the share. They own an option to buy the share at its current pricing. And now, if your company is valued at 1 million, and each share is valued at 10 euros, and you give out, let's say, that 1%, which is a very generous amount of stock options, by the way. And then 5 years from now, excuse me, you'll sell your company for 100 million. So then that person will have the option to purchase those shares. And now, if you think about it, that you've given that 1% of shares at the valuation of 1 million, so they'll actually have to pay you 10,000 euros to buy those shares. But those shares will at that point be worth like 1 million euros. So that means that, like, you'll pay 10,000 euros, you'll get 1 million euros, so you'll end up having like 990,000 euros in your bank account, and that's how stock options work. So in that sense, like, excuse me, in that sense, like, what I really like recommend is, like, very early on, especially when you start bringing in the first non-founding employees in the company, you set up a stock option pool for 2 reasons. First of all, it's a great way to motivate people, especially if you have if you have a high risk profile, which all of you will probably have in the beginning, but also if you have like great growth potential. So people will see that, okay, if I hang here for 5 years, I might end up being a millionaire. The second thing is, like, the second reason why it's important to set up an options pool is that, it's the right thing to do. Because ultimately your employees are going to be working, almost just as hard as you are in the company, at least if you make great hires. And I think, like, if you walk out of an exit with 60 million in your bank account and your employees get nothing, that's a really, like, I mean, and that has also happened. There have been quite a couple of cases like that I've seen from very, like, close by. And that's a really, like, ethically, like, not a good place to be. And you can combat that by setting up a stock options pool and having a program like, what Supercell has been doing, for example, or like Seriously, or like many of these like really successful games companies, that whenever somebody new joins the company, they automatically get, a set amount of options. And then, for example, based on their performance, like, they might get more along the years. And then, for example, when Supercell did their first, big deal to the Japanese buyers, then like most of everybody working there actually walked out of that as millionaires, which was nice place to be. And obviously, the founders walked out as like, with hundreds of millions, but when when everybody comes out on top, I think it's a very nice place to be, even if you as the founder will end up being like, a gazillionaire at the end of the day. So now to wrap up, so basically, like, in managing your financials in the company, it's really important to understand, like, first of all, like that, like your runway is like quite mechanically, like, the amount of income you generate throughout a given amount of time, reduced by the amount of expenses on a monthly basis. And when you do the type of cash flow projection that I showed in the previous slide, you can immediately see when you're running out of cash, and then you'll start to have to hustle either for additional income, or like, especially if you only have a couple of months of runway left, and starting thinking about like, what you're going to do with your expenses. You have a bunch of different ways of generating income. Revenue is, the best form of these. Obviously, always, and actually, usually we don't have the luxury of generating revenue in the early stage, so you're going to need some other forms of income to be able to, create your first product so that you'll actually have paying customers. And then the cap table reflects the ownership in the company. You'll want to keep your investors at, a maximum of 20% in each given investment round. You'll want to ideally keep the founders at more than 50% all the way to the exit if it's possible. And you'll probably want to keep your employees like committed in the ballpark of 10 to 15% of an employee stock option pool. Now, obviously, these figures will change. So each time you raise some investment, each time you create a new stock option program, the ownership amount will be diluted. So that means that your ownership will be less in the company. But especially with the investment rounds, that usually, like, if you're on a growth curve, that means that the valuation of the company will be higher. So you will be ending up owning less of a more valuable company, which, translated to plain old euros, is actually like, a bunch of more money that ideally, hopefully, like you'll be able to realize one day through an exit situation. And now let's break for 15 minutes. And then after the 15 minutes, I'll explain how you're going to actually do the first draft for your team about these documentations. And then we'll work on these for a while, and then meet up in about an hour for some commentaries and discussion about the documentations. But I think, like, the long and the short of this is, like, that when you're managing your financials, remember that cash is king. So that's by far the projected amount of cash in your bank account is the most important financial figure you need to be mindful about at every given moment. And you should have that figure sort of inked in the back of your head that you can quote it even in your sleep, which probably means that you'll end up not sleeping that much if it's, going to be negative sometime soon. But that's like, the kind of, dark side of startup life. And that's, I guess, worth taking the shot at creating something amazing with an impact that can even end up like, returning a lot of cash your way as well. There's a question about what was the book name you mentioned before. It's called Venture Deals. I can actually dig up during the break. I'll dig up the Amazon link to the book. So it's by this guy called Brad Feldman, and I don't remember the other author, but I'll dig out the link. And it's a really fantastic book about, like, how to negotiate with investors, and especially, like, learning about these intricacies and these myriad terms of the term sheet. And the shareholder agreement. If you parse Finnish, I wrote a book a couple of years ago called Kiitorata, where I also have, like, parsed the most typical terms in a term sheet, and I even have a kind of a, like, quick run through of, like, the typical terms in a shareholder agreement in that book. But Venture Deals is really sort of like, the kind of Bible of venture investment for the startup founder. So don't talk to VCs before you've read the book, okay? So because that will just like cover your back a lot, understanding how that stuff actually works. But hey,